bear with me. Okay. All right,
Tim,
so it is, yes.
Where
Yes,
do we
Steve.
find these recordings?
Oh, good point. Let me make a note, and I will, honestly, I don't know. I'll ask Henry because Henry will know better than I do. There's supposed to be a channel, and we realize the YouTube channel that we've got is kind of a mess, and we were talking about that. That's a good spot for it because it's easy to index that way. But let me find out, Steve. I should know the answer to it, and I don't know. Let me find out where the library is, and if we don't have them, we'll make sure to do it. I know where they reside. I just don't know how we make them readily available to everybody.
And we can go back in the archives then?
Yes, absolutely.
Okay.
Absolutely.
Great.
Yeah. I
Hey,
don't go
Tim,
back and check to see if there's something I regret saying. Just kidding. Little humor there. Yes. You got question? Go for it.
No, I was just saying, I've been looking at them. They're on YouTube. They're actually pretty well organized. It's under
Are they?
playlist. So I just linked
Okay.
to that in the chat
Okay.
if you want to take a look at it.
Okay, good. Glad to hear that. Thank you, John. Then they're on it. I'm not good at details. If that hasn't been apparent yet, I will readily admit it. I can barely do 80% of one thing at a time. At least I'm aware of that. So there's that's the good news. Anyway, if you're new, I'm Tim Quast. These are our Thursday vigorous demo and discussions around using Edge, and it's good to have you here. Okay, so I've got my usual hunk of things to cover. The only two rules are during the discussion, just mute yourself if you would, and then ask lots of questions. We'll try to address as many as we can. And if you have a comment, if you're a veteran user like many of you are, please weigh in, because I don't have all the answers. I use this I've traded multiple times today. I use it all the time. And when I pay attention to the data, it is very effective. When I don't, then I'm not very effective. So that's generally how it works out. Okay, so I'm going to kick this off, but if there are any comments to start, let me just make sure. John, thank you for that. I want to do one thing too here, that I'm going to put this in the while I'm thinking about it, so I don't forget. I'm going to put this link in the chat that I use this. I mean, I use it to look at the sectors. So you may have your own methodology. This is from State Street, and it's the sector spiders. We use it a lot to just keep track of how the core sector, they're the largest sector ETFs, clearly not the only ones, but it's a good source. And we will use that to compare the performance of the stocks that comprise those sectors. And those are only statistical samples. Yeah, I'll do that, John. But it's helpful to have that link, and I'll explain why here in just a little bit under one of my points. Okay, so there, wow, that was easy. Okay, that's the link right there that I just shared. So it's it's a very easy, free way to look at how the S&P 500's performing, what the top stocks are. If you want to look at a sector, here's the interesting thing. There are I don't know, there are probably, I could go look at the sector. I think it's over 150 stocks in this sector, but realize the communication services sector, they use like 26. That's their basket. And all ETFs can do that. Not all of them do, but all of them can use a statistical sample, a representative sample. And they're going to try to use ones that hew to the mean as much as possible. Things that skew are troublesome, and they'll get rid of those out of a basket. Now, back to the point. The first thing I want to talk about is what shifted. I try to go back and look at all the things that I mentioned in the market desk notes, as I said last week, and make sure that I address the things that I say we'll talk about. And I had said you could see the shift coming. I said on pre-market prep with the Benzinga gang on Monday. Look at the performance of the market is going to be different at the beginning of Q2, the second quarter. That's what that means, second calendar quarter of the year, than it was in the first quarter, where 3 of these sectors did very well. If you look at year to date, there's communication services up 21%, consumer discretionary up 13%. Tech up 19. Of course, those have given back a little bit even. But there's a reason, why those sectors did very well, and why there's a probability that they do less well in the second quarter. And it has to do with concentration in a small number of stocks. That's another point I want to come around to. But here's what I wanted to show you. So you would know a shift is coming because as we powered into the end of the quarter. So from here, this is the finish of March options expirations. Hang on, let me just go. I heard somebody knocking. There we are. I want to make sure and get Ray in. Okay, Ray, we're just getting started. You haven't missed much. So from March expirations into month end, right there. Big rise in demand, falling supply, and the market, jumped. And that we talked about how that's if you could see it, passive investment dominated all over the dashboard. And you'd say, well, it looks like it's continuing to rise. So why would the market begin to pull back? Well, here's your dovetail. You could go look at big tech, and big tech actually peaked about here before the end of the quarter. So a lot of that was done from March expirations into the few days leading into the end of the quarter. There's supply jump. You say, well, that's created stock to meet a requirement before the quarter finishes, and it's come down now. That the brokers are going to make sure they square the books. And it's not bad. There's nothing wrong here. That's because big tech can be growth and value. It gets the same funds. We'll use it for diametrically opposed purposes. Because what ETFs want is, they don't like this when I use the term collateral, but that's what it is. It is I'll give you this product and you give me ETF shares to sell to the public, says Morgan Stanley or another what's called authorized participant. Well, if people want a growth product, they can still, it might be Microsoft and Apple. They want a value product, it might be Microsoft and Apple. Because they're so large and liquid. Those 8 stocks, I've mentioned this last time, that the 8 stocks, I'll try to rattle them off. Apple and Microsoft, almost 13% of the S&P 500. Amazon right after that. NVIDIA right there, close to number 4. Google and both the voting and non-voting stock are members. Meta. Okay, where are we? We're getting close. It might be one off, but that is almost 25% of the S&P 500. And if the S&P 500 is biased toward value, they'll largely be treated. Maybe NVIDIA would be an exception, maybe not. Treated as value. If it's growth, they'll be treated as growth. And so it levels out here. But you could see that coming. You could see the communication services flattened out at about the same time. So it was principally short covering that gave communication services that boost into the end of the quarter. Same here, little dip in the supply side, different from big tech where there was a lot of creation of stock. That is the exemption that market makers have from the short locate rules. Core thing to understand about how the market works. But we'll know, we can see it in the supply side of the market. Those things were all portents of a change to come. If you get everything right by the end of the quarter, probably you're not going to repeat that process as the new quarter commences. And that's why I could say, well, I'm pretty confident there will be a shift. I don't know exactly what it's going to be, but it was pretty apparent in the data. And if you looked at low volatility and momentum, we had 1 or 2 days of good momentum. Momentum fell behind low volatility the last couple of days. Now it's reversed again briefly, but those are not great numbers. Energy's leading over here in low volatility, healthcare. And I'll look at a couple of stocks in there, but that's it. That's how you could look at that and you said, that's a lot of information. Well, it's not really. It's 1, look at the broad sentiment, what's happening there. Number 2, look at where 25% of the S&P 500 is in big tech, what's happening there. And then you could pick up the lead sectors and say, well, what's happening there? And that would be communication services, consumer discretionary, and tech. And so if you look at those and you see, well, is it likely to continue? It's not bad in any of them. That's why the market is, it's holding its ground, but it's certainly not awesome. It's not like the beginning of a big run. So therefore you expect the market will behave differently. That's what I mean about, anticipating the shift. So questions about that? Is there part of that that doesn't make sense? Let me know. And any additional observations that you've got. If you've learned something, then please holler. Yes, James, fire away. You might have you can just unmute yourself.
Hi, Tim.
How are you, James? Good to hear you.
It's glad to speak to you when you're not skiing, which is very rarely.
I hung up the skis for the season, so now I've got all this time on my hands.
Yeah. Well, listen, I followed the maths today, but not in momentum.
Okay.
I went to big tech and looked at Meta.
Yeah.
Because my question is, was Meta not in momentum today because it was under 8? Because that looked like the only reason why it wouldn't have been there.
Yes, that is why. Because the criteria, that is probably the only reason. Let's just confirm that. I mean, I certainly know what there could be 2. Yeah, go ahead. Keep going.
But it's 7 up with downward supply, way less than 40. We know that there's volume. So the only criteria that it didn't meet was being 8 or above. Is that correct?
Correct. Yeah.
Okay.
And it's the problem with with a blunt instrument, and I say that maybe that's not the best way to describe it, but the rigidity of math. If we have a bunch of instructions, one thing can mean that you're excluded, and you can say, well, then you're not really capturing it. Well, we're gonna stick with the things that to make it easy for people like me.
I
but
just
you're
wanted
right.
to make sure I was interpreting the data correctly. That it was only one thing that was out anyway.
Yep.
It opened up 0.5% and it's moved to 2% already today. So it opened at 0.5%. So it did what it was meant to do on its volatility. So
very good. You should take those. You should probably take the gains, because I don't know what's going to, and we want to talk about that over a 3-day weekend. Yeah.
But with momentum itself, I'm pretty sure over a year ago you said most gains come up to or including to 7.5 in the market.
Correct.
So why have we got the momentum set at 8?
Because they're individual. That's the difference. Is if you have, what James is saying for anybody who's confused is, he says if all the gains come up to about 7.5 in the marketplace, why would we only begin to track individual stocks beyond 8? Because this is 500 stocks pushing all the way to here 6.6, the last top. So that's why. And statistically, in the broad market, there are no further gains beyond that level, and 6.6. But for individual stocks, momentum's going to slam into 10, because it's just one thing, and there's going to be a lot more movement on that scale. That's why. And you might say, well, why wouldn't we want to just pick up the rise over 5? And we used to. That's the core principle, original principle of Profiler, and it's a blunt instrument. It's one of the big things that I want to come around to updating. It's just that we've got our hands full, and there's a we don't have 50 people working on development. We have 2, and so I want to come around to this. But our first principle was, well, when stocks rise over 5 and return to it, most of the gains are there. And if you did this with Meta, I don't know what it's going to show us, but what we found is that there was a greater reliability of keeping gains, particularly if stocks with momentum. If it was all the way up to 10, it was much more predictable that way. But that's excellent use of the data, James. That's good.
Thank you.
Yeah,
and thanks
absolutely.
for answering the question. Cheers.
Of course. So that's good. And you know, one other thing that came to my mind, James, as we were talking, is that it's possible. I'm just going to check this. That the amount of volatility might have excluded it too, because we try to find things with the best capacity to move, like Alibaba, which I bought. You know, I bought and sold it already. I took as soon as it was up a little over 2%, I took that because it took only an hour, and I thought, well, you don't miss out on anything. If I'm happy with the return, who cares? You know, I joke about missing out on Apache APA, which moved a lot, but you don't miss out. They're just, you know, if you're after a gain, take that gain. And if you don't get the gain, then it's not that you missed out on something. You just have to find something else. Yeah. So here's another criteria, James, that would keep Meta out of that. And I wrestle with that all the time. You know, because the average stock in the S&P 500 moves about 2.5% per day, believe it or not, between intraday high and low. So we try to be above that to get, so we set the criteria in momentum at 3. So you have to have 3% volatility to make the cut for that portfolio. Yeah.
And I think Meta's 2.5.
Exactly. It is.
Yeah.
Right.
Good.
But that's good. You can look, you can go beyond this. These are designed for people like me who can only do 80% of one thing at a time and don't have a lot of time. And so that you don't have to go do a lot of work. But if you got more time, do what James did. You know, you can go find it. I did this yesterday. You know, I'm not encouraging this behavior by any means because it's highly speculative. But yesterday, when Western Alliance was doing this and dropped 12%, I thought, well, there's a very strong chance that I can make 3 or 4% on it. I made 4.5. So, and I sold it as soon as it rose over 4%. It happened to be 4.5%, and I don't know what it did. I didn't go look again. I'm just taking the gain and moving on. But so you can do that. You can go freelance. Once you get the principles apply any place. It's just supply and demand. You know, it's math. It's not perfect, but it reflects the rules. It reflects how the machines are setting pricing. The machines are going to know the very same thing we do. These prices move on average over the trailing 20 days about 3%. They don't like to get outside of that because risk increases. The most risk-averse force in the market is Citadel, believe it or not. Citadel takes no chances. They want a tiny little gain, and they made $16 billion last year. We're saying we can't compete with Citadel, but we can apply the principles that Citadel uses, which is supply-demand imbalances and taking modest gains. So anyway, we can see that shift coming. Great example, moving to point number 2, and I've got several things here. But again, jump in at any point, is Marathon. And I was busy doing stuff. It was on the top of my list, and I screwed around, and I was 30 minutes late, and I looked and went, well, half the volatility's gone. But that was an absolute beautiful example of rising demand, falling supply, and a price that behaved abnormally. It doesn't have to behave abnormally. You can just use volatility, but you have a very high chance of producing a return in that situation. And so now, would I? It's 50% short. I looked at it today and I thought, no, that's too high for me. And look, it may or may not turn out. So I bought HAL, which was number 2 yesterday, because of that. Pretty good demand side. Supply reverting to the trend and down at 43.5 instead of 50.2. It's statistical. Doesn't mean that it's going to work out perfectly, but I would, in most circumstances, rather own that, even though I know that the upside is much less than it probably is in MPC, Marathon Petroleum. So that leads into, well, how do you know when to leave? It's what I would love in a perfect world is that we give you the entry signals here, and then as they reach exit signals, give you those too. And if we can figure that out with a level of comfort, I'll do it. But you can, absent that, you just have to do this. Let's look at maybe ELV, which is in the low volatility portfolio. You know, if you look at a stock like that, and so let's say you own it, and you know, you bought it here because, you know, the supply side plunged and demand did not move. Well, it's a great chance to get some gains. And then you get through yesterday and you're looking to go, wow, now supply is pretty well above trend and it's rising, and demand is not. Well, now, so you know that the supply demand equation may cause that stock to stop generating returns. Well, that's a great reason to leave. And we don't need that to be precise. We don't know it's exactly 7.5% above trend is the supply side. Look, we're studying that. And if there's something that manifests statistically that we could share that has a strong central tendency to be reliable, fine. But that alone would be a reason to go find something else. You know, is there something else that would be better in the same category that you feel comfortable? You know, no matter what the jobs data are tomorrow, would you be comfortable in a stock like this? Well, again, I'd look at it and say, yes, from the standpoint that it's below trend, but even that uptick is a little unsettling. I mean, if I were up in BSX today, I would rather take that gain and wait, because you can always come back and buy it next week. If the data are fine next week, we'll buy it next week. Who cares what price it is, so long as supply and demand are favorable to you? That's the key thing. And it's, you know, it's what's wrong with earnings multiples. Earnings multiples are an adjustment to reality. They don't dictate prices, they conform to prices, if you ask me. And it's because of the way that the market works now. So when to come and go? Any change to me on the supply demand side that reduces the probability of future returns is a good reason to take your gains. If the demand side falls, and I look at how, like, you know, I hope that I'll get more out of it, but I may not. And if not, then fine. It is what it is. But HAL has stopped rising, right? Is it HAL? Maybe it's EQT. Maybe I've got it wrong. HAL actually looks pretty good. So if I were to pick one that I was going to stay in, is it EQT? Maybe I have it wrong. If I could, wouldn't be the first time. Actually, both of those look pretty good. Let me go back to which one I was thinking doesn't look so good. Oh, maybe it's. Bear with me. Rather than make it up, I'll go look at the data. Apologies. I thought that I had that firmly in mind. So if you look at stuff that's topped, here it is. This is what I meant. So the other member of the energy group that's in momentum, you know, would I stay in that? Well, you could say they're diverging. Yeah, I mean, it's not bad, but it's certainly not rising anymore. So if I were in this today, heading into a market holiday tomorrow, and jobs data coming out, and did you see the revisions? So, you know, all of a sudden, it makes me uncomfortable that they do this. That right before a major jobs number on a market holiday, suddenly I think that comes out of the Bureau of Labor Statistics, certainly comes out of the Commerce Department. They decide to revise the entire year's data on jobless claims. And we went from having one weekly jobless claim number above 200,000 to having 9 in a row, because they revise them up right out of this number. The continuing claims went from one above 1.7 million to all of a sudden a whole chunk of them, like 6 or 7 in a row, one of them up to 1.9 million, I think. And they do this right before a job. That's just poor form. Shouldn't happen. But if I'm holding this, I would say, well, I'm going to be on the sidelines, because look, the market could be up on Monday, could be down. I don't know which way it's going to go. We'll talk about that last. But it's a great reason in context of when you say, well, what's changed? Well, we're in a momentum portfolio and it didn't get to 10 and it stopped rising. I don't think that that's a bad stock to own, but if it's flat at 9, I don't want that sitting there over the weekend, because maybe it goes down 4% on Monday. So it's just how to think about the exits. That's a core thing that we all wrestle with. Last item in this category is because I think it's a great case in point. And I'll say again, the reason I don't talk about Profiler much is because it doesn't do a good job of accounting for the supply side. We didn't design it that way initially because we had great data science on the concepts, but not in the practical application with trading outcomes. Now we have a lot of that data. But if you look at Tesla and you just say, here's what I mean about, determining your what thing changes, and let's say you buy the uptick and I think sell the downtick, and look at the outcome. If it's the one thing diverged, you can make 72% trading it and 72% holding it, except you trade it for 32 days and hold it for 65. Well, which thing's superior? If you can make the same return in half the time, that is the definition of alpha. Outperformance relative to risk, and time is risk. That is why. Because you say, well, why don't I just own something for the long term? Because that'll produce a better return. No, it won't. And it shows up over and over and over again mathematically. We expect that holding things for the long term produces superior returns. And yet, if you actually look at the math, it is just not true. I wish it were. But because the prevalence of profitable behavior in the market is very short term, that's what one has to adjust to. Not because I think it's a great idea. It's just that the math demonstrate over and over that that's the way to produce returns. Okay. Now, I want to talk briefly about concentration risk, and let me pause though to see if we've got things. Najee, you're seeing this, right? Najee, you're seeing the screen. Everybody's seeing the screen, right?
Yep. Hello.
Okay. Good. Okay. Good.
Hello.
Okay, Najee. Yes, it should be. Please fire. Yes, go ahead.
Quick question.
You
Have your team given any thought to maybe sharing with us your intraday trades? Like, I think you gave the example the other day, EQT is down 2%. You probably entered it maybe like 1:30 in the afternoon. You made a nice gain on that. It would be helpful if we sort of knew what you were doing, what you were thinking, maybe get a text or something like that. Just a thought.
Thank you, Calvin. Well, if there was some reliability to my actions, then I would do that. But it's not like that was scientific. If I have sold something, I will look around, and I might have sold, I forget what it was, and it's not more complicated than this to me. I'm going to go look. Let's see. I'll go. I'm not even paying for this data. I don't pay for a data set because I can just go look at. Let's use EQT as an example. So EQT, if I come to it and find, oh well, it's down most of its intraday volatility, and I like the supply demand balance, and I've got a day to play with. So I'm not going to buy that now because the market's closed and tomorrow and only an hour left in the trading. But if this happens, if it pulls back like this and I happen to see that, and you could set up alerts, of course, I just don't have that kind of time because I got other things that I'm doing. But if you do, then you could certainly do that. Steve Hicks is very good at that. You could use like a Benzinga Pro that gives you news and gives you alerts, things like that, so that you can find it. It'll tell you. My Interactive Brokers account will also tell me if something's up or down 2%. Not that I necessarily see that, but for me, that's what it is. If I know that that's about half of EQT's volatility, and I like the supply-demand balance, and I got time to operate, I'm buying that. I don't even think about it. I'll buy, 300, 400, 500 shares of it because there's a pretty good probability of getting a return. So I just don't want to lead you to believe, Kelvin, that I'm doing more thinking about it than that. The core of my thinking is going to be what has great supply demand divergence. What is the broad market doing? And are there things happening that I should be aware of? I always just come back to those same basic things over and over. Martin, fire away.
Yeah, thanks, Tim. Well, on the same line of question, does anyone have a way to capture what's in the momentum and transfer it into Benzinga or Alert or something? Just be able to capture those tickers and transfer them instead of typing them one by one.
Right.
So that would be very helpful.
You could, this is not the best way to do it. And Steve Hicks, maybe you've already found a way. You can export that to Excel. And then you could probably import those tickers into whatever platform you use. So,
all right, that works. That's one way.
Yeah,
If I can re-import the Excel files someplace
Yep.
else, that would work out.
And by the way, if you need something imported into, we'll add this feature. It's in the development list and it's been there for a while. And we went through an engineering change, and so it didn't get done when I expected. But if you need something imported into a portfolio, send me a note and I can have one of our team do it. It's not that complicated to load tickers into a portfolio.
Well, thanks a lot. Really appreciate that.
You bet, Martin.
Hey, Tim, question for you.
Yeah, Barry.
Would it be possible to download into an Excel file an individual doc with all the data like that's showing on the screen right now, so that you could do some analysis and maybe help you and your team come up with maybe scenarios, just like Steve's, 10 and following supply, or
The Hicks
following
rule.
supply.
Right.
We could do some analysis and offload you guys a little bit and try to come up with some scenarios that work. If we could, like I said, if like say I wanted to download the last year of HAL and look at all these different criteria that are on the screen. In Excel, you can do that and do analysis pretty nicely. And if you can come up with some scenarios that work, it might help you guys too. So you would have to give it the symbol and give it a time frame, like say the last year or whatever might be worthwhile. Maybe it's only the last 90 days, in the current market conditions or something. But give it a time period and then hit click, downloads into HAL.xls file, and you can look at it on the screen, chart it. You can analyze it, do the things on it you might want to do. So it's just an idea. It might help you.
Clearly it's a good idea. The reasons we haven't done it is something I mentioned last week. There are challenges for client side versus server side. For the beauty of this platform is we can serve data up really fast all over the planet. The limitations are you're not coming to the hive where all the data resides and doing that. So we'll figure it out. We'll get that figured out. It was one of the changes we had to make from 1.0 to 2.0, because you used to be able to just go over here and change the date, which could let you do some of that. So I hear you, and I think it's useful, and I think we'll get to that. And some of you, like John Cook, he's saying, he does some pretty good stuff by dumping data into pivot tables already. So yeah.
I was doing this by I did a portfolio that was all stocks in your database, and every day I would download that, and then I could do exactly that. But it's just you miss a day or you're off a day
and you're screwed. Yeah. So, your data's suddenly bad because of that. I get you, Barry. I do. And I appreciate it. Bear with me. We will find a solution.
No problem. We'll keep the ideas coming.
Okay. Thank you. All right. What else? What else we got? Open API. I know, John. I get you. But you're a tech guy. You know how much storage consumption that is. So it kind of gives me. There are 3 or 4 chess moves that have to happen before I can do that. So bear with me on that.
That'd be great. Hey, Tim, could you just go over how you calculate divergence from a formula perspective, or is it's written down somewhere I can go read it? Just was looking for it and couldn't find it.
Let me see. I mean, I know what we do. We take it's a standard deviation calculation. And so I look all the time for 4 standard deviations because it's a huge move, but I believe that's what it is. Let me confirm that. I don't have it right at the top of I'm going to write it down and I'll tell you what it is. But I think that's what it is, what the math is. Let me confirm.
Could you also screenshot the opposite of the momentum portfolio? I just love to see that thing so I can build it.
the opposite of momentum, which is the Barry Norton portfolio. And I don't know if Barry is here. Oh, you wanted my short. Okay, so I don't know if I have the exactly what Barry has done. I'll show you what I've done though. Let's see here. So wow, there's hardly anything in it right now. This is what I do, John, and it's mind you, it's informational. I use SH as a hedge, a short hedge, but that is. I'm sorry. So this will. I'll show you the math, and it may not be quite the same as the momentum portfolio, but you could do these almost like it. You know, the short volume trend is yep. That's probably right. Maybe the 1 day up. Maybe this should be 8 instead of 7, but that's a pretty good read. Statistically, that is a very good approach to finding stocks that have a high probability of declining over the next, call it 5 days. And mathematically, it's been pretty accurate doing that. And of course, this is liquid stocks. Okay, before we conclude, let me just, I've got just one last thing, and I know we're about out of time, and I want to leave you time to do whatever you need to do before, as I want to do, for the close. So the last thing I'll skip to, you know, what's the math show ahead of the jobs data? It's very good to have this look. What we know right off the bat at 6.2 is that broad market sentiment is above the red line again. And you can go back and look at that historically. It doesn't mean the market's about to fall apart, because look at the supply side. It has come down for 9, I think that's 9 straight days, which is really good. But it's above 50%, 50.3% as of yesterday. So I look at that data and say, you could have a very strong spike. It doesn't mean, you know, if the jobs data are weak, let's suppose they miss. What way does the market move? Does the market jump because now the Fed will stop hiking rates? Or does it plunge because people now, it's bets. It's not really people. It's what the bets are and what the balance in the book of bets is. Would people bet, oh, now we're going to have a recession, so then that's bad, and the market plunges? I don't know which one it will be. It's very difficult to say on a 1 day basis what's going to happen. But these are clearly not, as a general rule and almost a certainty, a setup for a big run for stocks. It's improbable. It doesn't mean it can't jump for a day, but demand getting to this level generally means that the supply side reverses. Look what happened here. That was the peak at 6.6. There were gains for the market, but it was the bottom for the short side. See down here? And then the supply rose and demand fell and stocks fell all the way into when the supply side bottomed again. Right? So it's not part, of course, this was a bank crisis, so that's funky data, and it explains why it was funky data. Why was the data like that? Well, now we know. But that's what we know going into this jobs data, that the market is at a top, the supply side has fallen, but it could very well be at a bottom. Probably we are not off to the races. Doesn't mean that the market won't have a 1 day good or bad response to what happens Friday. So then you have to decide what your risk tolerance is. Which side of the coin do you want to be on? You know, I think you're generally, when there are unknowns, you're better off to be in, if you're going to be in anything, to be in low volatility stocks. It's the better place to be, because they tend to be shelters, and even if the market is good, you can still get modest gains. They're better than momentum generally under those circumstances. You know, I don't really want to be in a couple of momentum stocks over the long weekend, and I hope it don't have to be. That's all I've got. So any concluding comment, or shall we call it good, and we'll find out where we are Thursday next week? Okay, well, enjoy the long weekend. There will be no market desk note, because you know, there'll be nothing to really write about till Monday, and then I can go get on a bike, which is my intention, and because I haven't done it for a while. So I hope you got happy Easter to you all, and enjoy the long weekend. And we'll catch you next week. Thank you. Good to see everybody.
Cheers.
You betcha.